welcome to TheoTrade. This is Don Kaufman. It's December 3rd, 2018, and you are watching the TheoTrade evening video. Minutes to go to the cash close. S&Ps are up about 28 handles. People, the G20 is over. Where do we go from here? Let's first dig into this by taking a look at not only the S&P futures, but really the anticipation and the move behind this kind of G20 summit. For that, I just want to display, if you will, a degree of efficiency in the marketplace that is absolutely uncanny. And let me describe it with this. First of all, we're looking at the S&P futures here. This is on, again, an intraday basis. This is an intraday basis. And for those of you that did miss the move last night, kind of scroll back here for a second. This is nothing more than a wild gap up. So effectively, this is Friday's close. This, of course, is the open on Sunday night. And we pulled right up and into our gravity point, which happens to be 28.11. Now, for those of you that recall or watch this weekend's video, we talk specifically about the idea of, well, what came out of the G20 would be a whole lot of nothing, but it would be positive news and we'd see a rip and rally. Well, we've got the rip and rally portion of it down. What we didn't necessarily get right is, quite frankly, I didn't think we'd make it to the 28.11 because that, again, is a staggering move to the upside. Nevertheless, we have been fading as this day has kind of progressed. For those of you that do not speak trader lingo, fading means, well, just that, kind of fading off into the sunset here as this day has progressed. And you can see the high being 28.14. Right now, where are we? Well, we're 20, 30 handles lower than that. For those of you, again, that don't speak trader lingo, handles are points. So a decent sized fade off of the highs of the session. Now, the part that I was mentioning a moment ago that was just like really just uncanny, and I was talking about this in the weekend video, had everything to do with what we term the expected move. And I want to describe this to you and kind of delineate a little bit of the process. So what you're looking at right now is is Friday's close. Okay, so it's Friday's close. Again, December 2nd is what we've backed up to, but it's a non-trading day, so it's really showing November 30th. So we closed on Friday afternoon, and this is the S&P futures at 27.64 with an expected move for Monday. What's Monday? Well, that's today. We had an expected move of about $49. Now, what that really kind of breaks down to is, again, I'll kind of draw it out over here because I think this stuff is of critical importance to your longer term success in this business. But here we are at 27.64, and again, that was Friday's close, and we're expecting this move either $49 higher or, okay, approximately $49 lower. And that's really what that expected move kind of delineates. All right, so where did we go? Well, just round it. Take 27.64, I don't know, add $50 to it. Where do you get to? It gets you to what? 28.14. So the marketplace is saying, well, we kind of should have gone to about 28.14. Check this out. Look at the high of the overnight session of the S&P futures, 28.14 on the button. So this is when I was saying, well, it's a binary event over the weekend, and we talked about the idea of a rip and rally. Listen, we had about a 50-50 shot of that occurring. And again, we believe that the rip and rally would ensue. We've had just that. Now, where do we go from here? Well, we anticipate a fade. And a fade, again, is the market's selling back off. And we've had a decent fade. However, the S&Ps are still up 30 full handles over here, which is, again, still a fairly spectacular 1% plus move, which actually brings me to the point to display once again the number of 1% plus move days that we've had in this marketplace is becoming astounding. And that's why I continue to reiterate the point that the volatility, people, it's far from dead. Now, I want to first go over to the spiders here because I think in the spiders, it's just cleaner. I have a lot of lines drawn on my S&P futures. But if you take a look at the spiders, we're still boxed in. And I've been talking about, again, this is what I call this volatility box, okay, with all of these, again, 1% plus moves okay, being priced in over here. These are all 1% plus moves almost on a day-to-day basis. We're seeing just that. That's why I've been warning a lot of traders, is this business about long being short? And the answer is yes. Long and short. All we have to do is ultimately get ahead of some of the sectors that we believe that are cyclically going to be either bought or sold, which actually brings me to a few points on this one. Okay, let's now cruise over to the financials. The financials led a big portion of the rip and rally that we saw last week. However, in today's trading session, I think that this is one of the single most important points that I can make on this evening's video. Today's trading session, the financials reversed, and they're actually going to end the day, okay? I mean, listen, the day isn't closed yet, minutes to go, but these things are, generally speaking, they're flat in comparison to where they opened. This has been, again, a phenomenally large range inside of the financials, and it's also something that we talked about in the weekend video where we thought that the volatility was extraordinarily high for those financials. Well, I guess there's a reasoning for it. Again, the financials on an intraday basis, this is the product that faded and faded right from the cash open. You have to watch and be mindful of those financials. In the days to come, it looks like the financials are going to be sold into. If that is going to be true in relative, S&Ps are going to go with it. And that is, we're going to see a fade inside of the S&Ps. Now, where are some other trading opportunities? Because obviously we believe that you could fade the financials right now. And if you want to get really specific, the XLF is always a good way to go. But if you want to get specific, take a look at a number of the financials. Now, we already maintain positions, short positions specifically inside of JP Morgan. But JP Morgan, again, right at the upper end of its kind of what I term a volatility box, could be faded at this point, very effectively if JP Morgan is to come back down. Other opportunities that we see. Now, here's one that's been off of our radar screen for quite a bit of time. Nevertheless, I still maintain positions, and that happens to be none other than Caterpillar. Caterpillar has been a story of, again, heavy sell-side activity throughout the course of this year. Now, I mentioned the year. Well, right here is where the year kicked off. Let's get really specific. We're actually going to pull this up on a year-to-date percentage. Caterpillar on the year still down about 11%. Looks ripe for the plucking, though, after this kind of wild up move. Again, this is 1, 2, 3, 4 trading days. 4 trading days. Takes a product that was down roughly 20% on the year. Okay, where is it now? Well, only down about 11, 12%. That's almost a 10% move in the midst of 4 trading sessions. With that, could there be some more upside inside of Caterpillar? Absolutely. Nevertheless, what better time to actually step in with either a duration put or an in-out put spread? For those of you unfamiliar with the in-out put spread, what the intent is to offset some of the volatility, offset some of your exposure by 1 strike in the money, okay? Maybe sell 1 strike out of the money. And effectively, what we've got here is a $2 wide spread for about a 95-cent debit. You're trying to achieve about a 55% return in there. Again, very advantageous at this point in time with the wicked rally up inside of Caterpillar. Another area that I happened to mention over the weekend was XLV. XLV. What is XLV? Happens to be none other than healthcare. The irony is we talked about a bearish position in this. Okay, well, that's already taken place to a degree today. This is one that I may actually wait on to see if it gets bid back up. For those of you, again, not in an XLV position, I've actually selected a duration position, that is buying a deep in the money put as a synthetic stock replacement. All right, last but definitely not least, let's cruise back over to the SPX for just a moment. Again, markets look like they're going to end the day up just about that 1% mark. Nasdaq also lit to the upside by the tune of about 1.5%. Why did we go back over to the SPX? Well, we got a little bit of a problem brewing in the SPX. That happens to be the markets are closed this Wednesday. That is, the markets are closed this Wednesday, December 5th, okay, in observance, of course, of the death of George Bush. Now, with that, the question comes, and we've had this dozens and dozens of times today in an email, what happens to the Wednesday option? Well, quite simply, it's going to go off to the expiration on Tuesday. That has been, okay, the press release from the Chicago Board Options Exchange, better known as CBOE now. Okay, CBOE has released that the Wednesday options will go off of a PM settlement. Again, a PM settlement, of course, on Tuesday. Okay, and that is Tuesday, which is tomorrow, December 4th. So all December 5th expiring options will expire, in fact, on the 4th. It's not just the spiders. It also happens to be what? SPX, spiders, okay, ES options on futures. There's a number of products, again, that are going to be affected by this expiration. Again, the Wednesday options will not expire on Wednesday because the markets are effectively closed, again, in observance of the death of George Bush. Instead, the options will expire on Tuesday. A PM settlement is the cash closing bell. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.